Hello and welcome to another webinar from us in Global Research. I'm James Smith. I'm here in London, an economist with ING. Today we're talking about oil prices, which, let's be honest, they've been on quite a journey, haven't they, over the last few weeks. Back a month ago, prices were going down and down and down towards $70 a barrel on Brent crude. But of course, that didn't last long before tensions re-escalated in the Middle East. And here we are, very close to $100 a barrel on oil, natural gas reaching new highs as well. So the question we're asking today is, how bad can it get for oil prices, for energy markets? How do we get back to those previous highs of $120 a barrel from earlier this year? And what does it mean for us in Europe? We've got an ECB meeting today. We'll talk about what that decision might mean and what energy prices are going to do to the outlook for interest rates and the Eurozone economy. Well, to do all of that, I've got two esteemed colleagues from our research team. I've got Warren Patterson, he's our global head of commodities strategy. He's in Singapore, and Bert Colijn, he's the chief economist for the Netherlands, and he's coming to us from Amsterdam. This is part of a summer series of webinars that we're putting on for you over the next few weeks, looking at how the market consensus could be turned on its head. And clearly, starting with the big topic of oil prices. And let's start with what you're thinking about with oil. We're going to start with a poll question for you. And the question is very simple. Where do you think oil prices are going to be at the end of this year? We've provided various ranges for you from below $70 a barrel up to, what have we got, above 120. So let us know what you think. We'll come back to the results a little bit later on. Warren, let's start with you. Warren, head of commodity strategy in Singapore. Let's cast our minds back a month or so ago. We had that memorandum of understanding between the US and Iran, and prices just kept falling, right? I think it surprised most people in the market. Why did prices come down so quickly?
I mean, the short answer, I think, is just false optimism, right? The market basically treated that MOU as almost a final deal, and seemed to have largely ignored that there was still a massive gap between Iran and the US. Now, fundamentally, we did see a flood of oil coming out from the Persian Gulf following that deal, with obviously all those tankers that have been sort of trapped in there for months, making a quick exit. And that was sort of coinciding with continued releases of oil from government stocks. So ultimately, the supply recovery that we were seeing in the market was happening at a much quicker pace than the demand recovery. So the physical market was actually pretty weak. I think there was also an element of the market believing that the pace of oil flows that we were seeing sort of from the Persian Gulf could be sustained. And I think that's also where the market was probably being too optimistic, right? Because yes, we were seeing plenty of tankers leaving the Persian Gulf, but they were a little bit more reluctant to go back in. So I believe we could have probably seen a slowdown in oil flows, even if the deal had held, but obviously just not to the degree that we've seen them slow down in recent weeks.
Let's talk about those oil flows and sort of where we are now, because I think one of the challenges throughout this crisis has been really putting your finger on how much oil is coming out of the Middle East. We get this data on tankers, but there's a lot of questions about how reliable it is. I mean, do we have a decent sense of where we are right now in terms of the amount of oil coming out of the Strait of Hormuz in the Middle East more generally? And I suppose related to that, fresh headlines today, strikes in the Red Sea on tankers as well. How big an issue is that going to be?
Yeah, I mean, on sort of monitoring flows through the Strait of Hormuz, very difficult at the moment. If you look at sort of ship tracking data, it basically shows that tanker flows have essentially ground to a halt. And again, no surprise given the fact that we have been seeing tankers been targeted in the Strait of Hormuz. But basically, as has been the case since the start of the war, right, we are seeing a number of vessels moving in the dark, so basically turning off their transponders when they transit the Strait of Hormuz. So actual flows will be higher than what official data is suggesting. Now, we did see oil flows basically go back up to around 12 million barrels a day following the deal. we're basically assuming now that those flows have fallen back to somewhere between 2 to 3 million barrels a day. So basically back where we were for large parts of the second quarter. As for the Red Sea, yeah, obviously a very real risk for the market. As you say, we've seen the Houthis taking responsibility for a couple of strikes on tankers overnight. Obviously, the Red Sea has become increasingly important for the oil market, given the fact that since the war, we've been seeing Saudi Arabia diverting a lot of its crude to the west coast in order to bypass the Strait of Hormuz. So in June, flows were about 4.6 million barrels a day. And so clearly, that's sort of the supply that we see at risk. I won't say that basically that full volume is potentially lost, given the fact that Saudis can always basically ship through the Suez Canal. Yes, it obviously adds to voyage times into Asia, and it also makes freight a little bit more expensive. But it certainly doesn't mean that the oil is shut off from the market.
And let's talk about inventories, Warren, because you mentioned it in your first answer. That has been very helpful for the market, throughout this crisis. And I think you mentioned the US strategic reserve and how that's kind of been helping matters. I think, correct me if I'm wrong, I think that was kind of winding down, or is kind of reaching the end of that initial release, right? I mean, is there scope, given that the US is kind of escalating things in the Middle East, military strikes aren't winding down, is there scope for that to be extended?
So on the surface of it, I mean, if you look at it, the US has released more than 100 million barrels from the SPR so far. It leaves the US SPR at about a little over 300 million barrels, which is the lowest levels we've seen since the early 1980s. So yeah, on the surface of it, you could look at that and say, oh, the US might be reluctant to tap more into those reserves. But I think it's also important to remember how these releases are structured, right? They basically structured in the form of an exchange. So for every barrel that we've been seeing released from the US SPR, at a future date, we'll see on average about 1.2 barrels returned. So ultimately, at the end of all of this, the US SPR should actually end up larger than where it is when it started, when the war started. So I think if the government were to structure further releases as an exchange, they certainly would probably be willing to announce further releases.
Now we have to talk about China as well, who've played an enormous role in the sort of the price backdrop throughout the crisis. A big cut in demand for oil over the last few months. I suppose the big question is, can that continue?
Yeah, I mean, I think China has probably been the biggest surprise in the oil market throughout this war, right? I think just the degree to which they've cut their imports is just astonishing. If we look at sort of June imports, they fell 40% year on year. In barrel terms, that's a 5 million barrel day reduction. So just amazing. And that's really been crucial in helping to try sort of rebalance the market. Obviously, a large part of that's been driven by demand destruction. If you think sort of feedstock availability for the petchem industry has been disrupted, so we would have seen a large amount of demand destruction there. But also when it comes to sort of road fuels demand, so demand destruction certainly played a role, but also inventory drawdowns. That's also helped to sort of make up for some of this decline in imports. Now, I'm of the view that China could sustain sort of these lower imports for some time more. China sits on sort of more than 1.2 billion barrels of reserves, and to be honest with you, through this war, what they've released from that reserve, well, it hasn't really dented that number too much. So I think we could go for a few more months with these lower import volumes if needed, and then China could look to restock in 2027 when the market is expected to be in large surplus. Now, the big issue and uncertainty, of course, is obviously the longer this disruption persists, the more careful China will want to be about tapping too heavily into its reserves.
Now, Warren, the whole sort of premise of this webinar is what happens if oil prices go back above $100 a barrel. But for diesel, we're kind of already there, right? You know, it's already a very extreme situation in the diesel market. Spreads have widened out considerably. Why are things so bad?
Yeah, and to be honest, it's not just diesel; it's the refined products markets in general. But clearly, I think diesel's sort of the poster child for that tightness when it comes to refined products. You know, you started off saying we're sort of edging towards $100 on Brent. Well, if we look at ICE gas oil, we're trading at almost $170 a barrel, right? The gas oil crack, it's gone from a little under $40 in June to record levels of $65 at the moment. There's a number of factors at play here. Clearly, the Persian Gulf is certainly a bullish factor here. Around 11 to 12% of global refining capacity sits in the Middle East, and obviously a large amount of this will be disrupted due to the war. Refinery runs in Asia obviously would have also been impacted due to feedstock availability issues with crude from the Middle East. And then I guess sort of the real big factor, and maybe doesn't get as much attention as one might think it should, is the impact of Ukrainian attacks on Russian energy infrastructure. It has led refiners cutting run rates significantly in Russia. As a result of that, we are seeing diesel exports in from Russia coming under significant pressure. Just in June, exports were down 50% year on year. July, they will come under even more pressure given the fact that the Russian government announced a temporary ban on diesel exports. And this is very important for global diesel markets because Russia is the second largest diesel exporter globally. And unfortunately, I think for the refined products market and diesel as well, there's only really one way to fix all of this, and that's sort of to get a normalization from the Middle East in terms of refined product flows from there and crude flows as well, so that Asian refiners can see sort of increases in their run rates once again. What is the one bit of relief, or what's the one part of the market that can offer some relief, should I say, to the refined products market? Well, it has been the US to a certain degree, right? They have been ramping up exports of refined products. The issue is that US refiners are now essentially operating at capacity. So any sort of additional relief that they can provide to the market is very limited.
Now, Warren, let's check in with the poll that we asked you earlier. Where do you think oil prices are going to be at the end of this year? Answer: no one knows. A really big range of responses. I suppose not surprising given all the uncertainty. Most people, about a quarter of you, saying between $90 and $99 a barrel, which is roughly where we are today, and a similar percentage at just over $100 a barrel. Warren, what do you think? And I suppose on top of that, given the title of the webinar today, what does it need? What would have to happen for us to get back to $120 a barrel or even higher?
Yeah, I mean, firstly on that poll, I think it really demonstrates just the uncertainty, right, within the market, and it's a very tough one to. It's a very tough market to forecast at the moment. It's it could play out. It just sort of we've seen over the last few months. In the short term, I think it's only a matter of time before we break $100 a barrel. Easy to say, you know, we're trading close to $98 a barrel at the moment, but I think it's just a matter of time, given the fact that it's just little sign of de-escalation in the Persian Gulf. If anything, we continue to see the situation getting worse. And on top of that, we've also got some supply disruptions elsewhere, right? In the Black Sea when it comes to crude loadings from Kazakhstan there. So the market is looking increasingly tight. So I suspect we do see prices moving higher. And then it sort of comes around to I guess sort of having a view of where's sort of the pressure point for Trump. You know, once we get sort of sustainably above $100 a barrel, is that enough for Trump to sort of come back to the negotiating table and say, well, let's sort of try get this deal back on track, possibly. From the Iranian side as well, we've obviously got the US blockade back in place. The longer that goes on for, you'd think the more willing Iran would also be to come back to the negotiating table. So I think in the short term, we could certainly see spikes above $100 a barrel, but with the view that potentially we still see negotiations getting back on track over the course of August, our base case is essentially that we could still see Brent below $80 a barrel by the end of this year. Now, sort of what it would take to get to $120, well, to be honest, not much. We just need to see what we're seeing at the moment persist for a bit longer. If we sort of run through with these supply disruptions through August, it's only a matter of time, I think, before we hit $120 a barrel. Remember, the inventory situation now is a lot tighter than where it was when we started the war. So the market hasn't got that buffer. So yeah, I think we don't need to see too much to basically get to that $120 level. And then I guess the key question is what could take some of the pressure off the market? Well, China, obviously, if they continue to do what they've been doing, that could help take some upward pressure off the market. But I think more broadly, when it comes to demand, just given the fact that we could see basically demand destruction at these price levels, and you might say, well, we need to see higher oil prices for that to come through. But at the end of the day, we don't consume crude oil, right? We consume jet fuel, diesel, gasoline. And as we've touched on already, with gas oil at $170 a barrel, we're already at levels, I think, where you will start seeing sizable amounts of demand destruction. So I think the demand side could start coming through once again to try to help rebalance the market and take some upward pressure off prices.
Now we're going to come to what all this means for the ECB in a few moments with Bert. Before we do that, Warren, one final question for you, just quickly. Natural gas, a big problem for us in Europe. Prices are rising. How bad could it get? Why are prices rising here?
Yeah, it's certainly not getting as much attention as the oil market, right? And you could argue, as you say, it's probably a more important factor for Europe. At the end of the day, storage is just not filling up quick enough for the EU. It's 54% full at the moment. We're basically tracking levels seen in 2021, and given the fall in LNG imports into the region, it's looking very unlikely that the EU is going to hit its 80% storage target ahead of the winter. I think even hitting the lower target of 75% looks as though it will be tough. Now on the import side, those volumes have come off drastically. In June, they were off about 20% year on year. It's looking as though that decline's picking up pace through July. The issue here really is that we're seeing Asia competing more aggressively for supply. So that is seeing LNG supply diverted away from Europe into Asia. And then secondly, on the demand side, obviously Europe's been going through a number of heat waves recently, and that has been supportive for gas demand from the power generation sector. And we've also been seeing something similar in parts of Asia. So that's really what's tightening the market up. I think if we see these supply disruptions really persisting through pretty much the whole of Q3, we could certainly see a scenario where TTF sort of averages around 85 euros over the fourth quarter of this year. But again, that's not our base case. Maybe the one saving grace potentially could be weather. We are set to see a strong El Nino event later this year. And while obviously El Nino events don't usually have a strong impact on Europe, if it's a strong El Nino, it can lead to sort of a milder start to the winter. So potentially weather could save Europe once again, like it did during the 2022 energy crisis.
Thanks a lot, Warren. Warren, as I say, our chief energy strategist in Singapore. Now let's talk about the ECB, and let's start with what you are thinking about rate hikes for this year. A very simple question. How many more ECB rate hikes do you expect over the next 12 months? None, or I suppose implicit in that, do you expect rate cuts? 1, 2, 3, 4 or more? Let us know what you think. We'll come back to the results in a few moments. But we'll talk about the ECB more in a minute. But let's start with inflation. Inflation has actually come down already from, I think, 3.2% in May to 2.8% in June. Are we past the peak?
Well, not with these prices in the energy market, we're not. But it did look like that for a while, right? So I think what we saw over the past months was something where we were coming past the peak. We saw that we were getting into a more benign environment again. And overall, we also even heard from the ECB something that was a bit of a relief. Lagarde said in Sintra last month that the ECB wouldn't need to step in as aggressively as it did in 2022. I think that makes sense. No one's really expecting that it would, but I think that already showed that there was a bit of calm coming out of the ECB around this current inflation environment. But all hands will be back on deck, because if we look at these oil prices and also prices in the gas market, especially as you were just talking about, that's a very different type of environment that we could get back into, where potentially you will see inflation shoot back up again.
Let's talk about second round effects. I mean, you mentioned there, Bert, this isn't 2022. This is very different for a whole host of reasons. I think most people agree that getting back to that sort of 2022 inflation wave is unlikely. But nevertheless, the ECB does worry about higher energy prices spilling into the rest of the inflation basket. And I suppose those concerns will be heightened if we do go much higher on energy prices. I mean, is there much sign of that so far?
So I think so far it's been relatively benign. So of course we've seen the big surge over the spring, and there we saw that businesses were immediately much more keen to price through higher costs to their customers. So we see in surveys from the European Commission, for example, that a large amount of goods producers were planning on increasing their prices in the months ahead. That usually correlates quite well with goods inflation in the consumer basket as well. So that's definitely something that we will see. But we already did see as well that surveys in June and May were already showing fewer companies that were willing to increase prices. So there's been a small tick down. Not that that means that we're not going to see a further increase in core inflation, but it does mean that sort of the sharp edges are starting to come off, or were starting to come off a little bit. Of course, when oil was back at 71 or $70 per barrel, at that point, it becomes a lot more difficult for corporates as well to start to price through higher costs to their customers, because if they point to higher commodity prices and everyone can see that oil is back at where it was before, then that does make it harder to price through those few months of extra cost to their customers. But now that we're back up close to $100 per barrel again, that burning platform becomes larger. And of course, it means that the chances of businesses trying to pass through those higher costs to their customers increases as well again. So if we look at those direct second round effects of what's happening here, the risks around those are starting to increase again with current prices, even though signs were very encouraging in the months before. But maybe we can take that even broader, James, and also look at the labor market, which is a much slower second round effect that you usually see happen. In 22, when we had inflation past 10% in the Eurozone, we did, of course, see that resulted in a slow but sure increase in wages that came on the back of that. And the ECB invested a lot in trying to make sure that they understand that labor market well and understand those wage moves quite well as well. So they've introduced a new wage tracker that they didn't have before the previous energy shock. And if we look at what that wage tracker is currently showing us, then we are seeing that it's showing very little effect so far. The ECB tracks big negotiated wage agreements across the Eurozone with that, and it's not showing much effect yet, even though we are starting to hear that unions are immediately trying to recoup purchasing power from the increased inflation that we see so far. But let's be honest, I mean, with inflation around 3%, that's not really something that's going to bring about a big wage wave on the back of it.
Let's talk about the ECB then, today's meeting. But let's check in on that poll that we just put out in terms of what you guys are thinking. A little bit more consensus here in terms of the extent of the ECB hikes. One more hike is the majority view, 55%, followed by 2, and only a handful of you putting in 3. But nobody's expecting a hike today, I don't think, from the ECB. The ECB doesn't like surprising us. Is it going to be a bit of a non-event, or is there indeed some scope for surprises, what you're expecting?
So, I mean, just a few weeks ago, before we got back into all this, I would have said that this was a non-event and that everyone could safely go on holiday. But now, today is going to be quite interesting still. Maybe not indeed from whether there's going to be a hike or not. It would be a big surprise if they would do something today. But especially in terms of tone of voice and the discussion that is going on behind closed doors at this point. around what the ECB is going to do. I am sure that there will be more pressure from the hawks now to push through for a second hike, maybe not today, but then it definitely will be for September. Doves are more uncertain about the economic impact, and will try to push back against that and want to see how this new situation is going to play out and how long it's going to be in place for. But overall, it will be a very interesting press conference that Lagarde will give. See how much of a hint she's going to give towards a September hike, how definite they'll want to make that come across, and I think that's going to be very interesting to hear also how they view possible second round effects. So I think it's going to be an interesting one for the ECB that could, especially the press conference, have an impact on market pricing as well.
Yeah, and speaking of that market pricing, but I mean, you mentioned the second rate hike there. Markets are indeed expecting not just a rate hike in September, another one thereafter, and maybe even another into next year. A string of hikes priced, and this is very correlated the market expectations to the level of energy prices. So not surprising that those are rising. I mean, we don't have a crystal ball on the energy crisis. We're not geopolitical experts, but given where we are right now on energy prices, are markets wrong? Is that too extreme in terms of the pricing?
Well, I think what we see in terms of ECB pricing, when you go beyond just the second other one, it means that the ECB would go beyond their own estimates of what the neutral rate is. So essentially, it means that the ECB will actively want to push back on inflation levels. And yeah, I mean, with oil prices rising so fast as they are right now, with gas prices on the move, of course, that means that you can see scenarios where inflation will move significantly higher. That could require the ECB to step on the brakes more significantly. But at the same time, if you consider a base case in which this is going to last for a bit longer, but not all too much, then it could well be that just the one more is going to be enough for the ECB, right? So the market seems to be pricing something where inflation is somewhat more persistent than what we're at least expecting at this point in our base case.
Thanks a lot, Bert. Bert, chief economist for the Netherlands on the ECB there. We're almost up for time, but I do want to take one question. We've had lots of really good questions, actually. I think quite a few of them Warren has already answered, but I do want to come to you, Warren, with one, which is a very good question. And it is, if markets now accept that Iran can disrupt the Strait of Hormuz whenever tensions flare up, shouldn't oil be trading with a permanently higher risk premium? In other words, what would need to happen for prices to get to pre-crisis levels?
Yeah, I mean, I think that's been the big surprise, sort of with that initial sell-off in the market, right? When we did see prices trading to the low 70s, essentially that whole risk premium evaporated. Look, I think what we need to see is clearly that there is this risk that's going to be hanging over the market. But what we do need to see in order to sort of get back to pre-crisis levels, I think, is for sort of just a sustained period of an unsustained period of flows not being disrupted, right? So if we sort of go a quarter or a couple months without disruption, then that risk premium will really start fading, and then I think the market's attention will really focus on the expected surplus in the market for 2027, which is sizable, right? You're looking at, assuming these disruptions sort of end sometime this quarter, you're looking at a surplus of in the region of 3 to 4 million barrels a day through 2027. So I think that's when the market really will focus on that, and you see prices going back below pre-crisis levels. I think sort of longer term, what this does, though, it certainly does sort of change dynamics quite drastically in the oil market, because we are going to certainly, I think, see investment in infrastructure to essentially bypass the Strait of Hormuz, right? You're already hearing talk of the Saudis looking at expanding capacity for the East-West pipeline. The UAE, which has actually dealt with this war very well, is also expanding capacity of its pipeline to ship out of Fujairah and avoid the Strait of Hormuz. That should be ready next year already. So I think in the longer term, yes, Iran has demonstrated its ability to basically shut the Strait of Hormuz, but in the longer run, it's also pushed the markets, or pushed the market to basically I guess, shift its ability to basically avoid the Strait of Hormuz.
Thanks a lot, Warren. So many interesting things we could talk about. Lots of really good questions. So thanks for all of those. We're up for time for today, but we are back in 2 weeks' time. This is part of a webinar series we're planning throughout the summer. The next episode, we're talking about the Fed markets pricing various Fed hikes over the coming months. We're not so sure about that. So we're talking about how the Fed could actually end up cutting rates by next summer and sort of stress testing our views a little bit there with James Knightley, who's our US expert in New York, and also Chris Turner here in London. He'll be talking about the dollar. Good news, you're already signed up to that by signing up to today's webinar. You're already signed up to the next series of events. Just add it to your calendar. There's a button on your screen right now on the webpage that it'll take you to, lets you click a little button and add it to your calendar. So do that, and we'll of course get more details emailed to you over the next few weeks with more episodes as well coming through the summer. That's it for today. Thanks to both Warren and Bert, and for you for joining us today. Speak to you again next time. Goodbye.